So, quick introduction. My name is Mark Lamonica. I look after the individual investor business for Morningstar here in Australia. And today we're going to talk about asset allocation in retirement, or as you're approaching retirement. But first, we have to go through our housekeeping items. Anything you hear today is general advice. I obviously don't know anything about you, so I can't offer personal advice, but would love questions. So send through any questions that you have. And yeah, we are going to get into it. All right. There you go. You can listen to our podcast or follow us on Instagram. We put up a new video on Instagram yesterday of me sitting on that bench, which is very exciting. All right. So as I said, asset allocation. So we're going to talk about a couple different things. We're not going to spend as much time on goals today because in many cases, this involves meeting your goals. If your goal, of course, is retirement. But remember, as we go through the process, and particularly if you are still in the transition to retirement, what we're trying to do, of course, is accomplish our goal. And the way that we do that is we write down our goal and we figure out what return it's going to take to actually achieve it. Excuse me, along with the other inputs like how much money you need to save. And that allows us to, of course, focus on risk capacity. All right. Well, what we're going to think about when we think about asset allocation, and this will be very important, is the relationship between risk and reward. So we're going to use a couple simple examples, but as investors, what we are doing is, excuse me, we are exchanging risk as measured in volatility. So how much a share price, for example, bounces around, but in the aggregate, how much your portfolio bounces around. We are exchanging that risk for returns. So as long-term investors, we can take on volatility to get higher expected returns over the long term, right? That's a trade-off we're making. Now, the example of this is cash has no volatility, right? So cash is not going to bounce around. You put cash in the bank, you're going to be able to take that cash out of the bank. Now, the problem is you're not getting a return. The other problem is you're likely getting a negative real return, meaning after inflation, your cash is going to lose value. But remember, it's not bouncing around a lot. On the other hand, if we go to shares, they bounce around a lot in price, but over the long term, we expect higher future returns. Now, of course, the issue with this, it's very easy to sit here and talk to people that are 30 and have 35 years ahead of them of investing, talk about minimizing volatility, but volatility becomes very, very important during certain times of your life, like the transition to retirement and into retirement, because in that case, where a 30-year-old saving for retirement, it doesn't matter what their portfolio is in a year or 2 years' time, doesn't matter to them. It could very much matter to you if you are right on the cusp of retirement because you're trying to achieve that goal. So sometimes what we need to do is we need to understand that the way that we achieve our goals when we're getting to retirement is by limiting volatility. And in that case, you are getting something very positive. You are protecting your portfolio from the downside, and you are giving up something. You're giving up the potential for higher returns. And over the long term, we know we're going to get those higher returns. In the short term, we do not. All right. We're going to use an example of the relationship between risk and reward. And I think this example hopefully will bring this to life. So we're going to talk a little bit about statistics, but it's going to be a very quick discussion. And conceptually is what we're looking for you to understand here. So we took two different ETFs. BetaShares Australian High Interest Cash ETF. It's basically cash, short-term fixed interest. Then we took the Vanguard Australian Shares ETF. So this represents the ASX 300. And we're looking at both those things we've been talking about. So we looked at returns and then volatility. And volatility is measured by standard deviation. So you can see we have the definition of standard deviation down here. So it's a measure of the variation or dispersion in a set of values. And that dispersion is around the average, right? So we can all obviously calculate the average of something, but how much does each individual reading that we have? So if we're looking at average annual returns and we look at then the individual annual returns, how much do they bounce around compared to that average. And that is volatility, right? So it's that dispersion around the mean, the dispersion around the average. Now, statistically, when we look at that, we can actually go back and calculate using something called a normal distribution where returns should be. So let's look at this. And standard deviation, a higher standard deviation always means more volatile, means that there's more dispersion around that mean or that average. So let's look at both of these. So the standard deviation over the last 5 years for this beta shares, basically cash ETF, is 0.21. We'll talk about what that means in a second. And the annual return was 1.37%. And Vanguard Australian shares over the past 5 years, you got close to 10%, but a much higher standard deviation. So how should we think about standard deviation? Remember, it's the concept that's important. So within one standard deviation in a normal distribution, you would expect 68% of the time for the returns to be within one standard deviation. So basically the way we calculate that is we just add and subtract, because returns can be higher and lower. We add and subtract the standard deviation from the average. So 68% of the time, the return will be between 1.16, where we've subtracted it, and 1.58, where we've added it. Two standard deviations occur 95% of the time. So then we subtract it twice. So we subtract 0.42 and add 0.42. Now, the important thing to remember is whenever you hear people talk about like tail risk, so the tail in a normal distribution is what happens outside of this 95%, right? So the two tails, if we think about a normal distribution, the two tails are on the side, right? So what are those freak outliers where the market goes up a ton or goes down a ton? We want to worry about that. But what you can see here, when we do this with Vanguard Australian shares and look at that standard deviation, we're getting big swings, right? So 95% of the time, your return will be between negative 18.66 and 38.46%. The reason we're making this point is because as you approach retirement, we talked about this last time, as you approach retirement, you're trying to get to that goal. If you have one of these negative 18.66% years, that could be really, really bad, right? So if we think about a portfolio's growth over time, the most money that you ever have is generally, because of the way compounding works, right before retirement, right before you achieve that goal. And that is when the dollar losses of one of these very negative events or a tail event can be devastating to your portfolio and can really impact your retirement. And that's what we were talking about before. We were talking about longevity risk and sequencing risk. So sequencing risk is the order of returns. The order of the returns matters a lot. It's not just the average return you receive over the lifetime. You want to retire, ideally, you want to retire into a bull market. So you want the market to be going up as you retire and in the early years of your retirement. You do not want the market to go down. So, it's the interesting thing that, like, when do you want the market to go down? If you're 30 years old right now, you should be praying that the market goes down for the next 10 years, the next 15 years, right? As you start earning more money, you'll save more. And ultimately, we're still thinking about the same average returns. Ultimately, you want those negative returns early in your investing career and when you're earning more money. And then you want very positive returns going into retirement. But we're talking about retirement today. So we're talking about that risk that you're trying to minimize. So how do you do this, right? So if I'm sitting there looking at creating a portfolio between, and these are extremes, obviously, but between 100% shares, 100% in this Vanguard Australian shares, or 100% in cash, I want my portfolio to be closer to the cash side if I want to minimize volatility, right? So obviously, in a 2-asset portfolio, if we're multiplying how much we allocate to each one of these, right, we can figure out the standard deviation of the portfolio. All right. So we'll talk a little bit about where Morningstar sees returns and standard deviation over the next decade. So our team, our investment management team, puts together projections on each asset class. So we used a very simple, and I could have done that with other ETFs, obviously, We did a very simple sort of look at two extremes, shares and cash. But, you know, there are more asset classes that we generally recommend you invest in. So what our team does is they project forward returns that we believe will occur over the next 10 years. Then we look at the standard deviation. How much dispersion do we think we'll have around that mean? And so what you can see is that in anyone who's been following the market lately, it should automatically jump out at you that these returns are lower than what we're used to. So we believe as a company, because of where valuation levels are, that we will have lower future expected returns than we've had in the past. And you know, the very simple description of this is if we think about the sources of return. So how do you get returns on shares? Well, three things determine returns on shares. What is the dividend yield? So you get returns from dividends. Dividend yield in the market is very low compared to historic because share prices are so high. Valuation levels are very high compared to where they have been historic, and you get return from changes in valuation levels, right? If somebody's willing to pay you 10 times earnings for a share today and 20 times earnings for a share a year from now, that's very good, right? Your share price, all things being equal, would double. We don't think you're going to get anything from increases in valuation, even if valuation levels don't go down, there's not as much upside because you know, they're very expensive historically. And then the third place, of course, is earnings growth. And, you know, in times where you're not getting a lot from those other two things, you better hope you have strong earnings growth. But anyway, as you can see, you know, we especially, and we look at global shares versus Aussie shares here, especially we think the US is overvalued. So that's in the aggregate. So that's 6.75%. It's obviously significantly lower than what we have for Aussie shares. And I will say that just because I have seen the numbers behind this, it's really the US, which makes up so much of global markets, that we think is actually dragging that down. Then, of course, you can see a bunch of other asset classes, look at the different returns we have projected there. And then, of course, the standard deviation. So the question, of course, is if you are approaching retirement, what sort of portfolio mix should you put together, realizing that volatility can be very dangerous and impact your goal. So one thing to note before we start looking at a couple models, and hi, Peter, send through any question you have. One thing we do need to know is there is no correct asset allocation, but there is one that works for you. And that's why what we're trying to foster on these things is understanding of the different issues you face and a way to evaluate your own situation so that you can make decisions. So every person that enters retirement obviously has a unique set of circumstances and goals, and that is going to inform your asset allocation. Your asset allocation, your portfolio cannot be looked at in isolation, right? It has to be looked at with your life and everything going on in your life. So what are some different considerations? You know, this is a polite way of saying how much money you have. So when we think about the mix of your spending between needs and wants, and same thing, the ability to scale spending, it's really talking about how much money you have, right? We all have things that we need, right? We need shelter. We need to feed ourselves. We've got healthcare needs. And then we have everything that's on top of that you may think is a very essential part of your life. And I think it's a very essential part of my life, but you'll be able to survive without it, right? And so that can be everything from travel to spending money on nice clothes, cars, whatever, all the luxuries in life. The simple way of thinking about asset allocation is that if you have a big buffer between being able to survive and the life that you actually want to live, you know, your portfolio is supporting spending up here, but you only need a little bit to actually survive, and it's a smaller percentage, you can generally withstand more volatility, right? If you are barely scraping by and barely able to meet your you know, base needs of shelter and food, then you need to worry a lot more about volatility and need to be in a lower volatility portfolio. And basically what it is, it's around this ability to scale spending. And maybe you could be sitting there saying, I can't imagine a life where I'm not, you know, traveling to Europe every year. Maybe, but you can survive not doing that. In fact, you have the last 3 years. So that allows you to scale your spending, right? So if there's more volatility in the stock market, if that causes you to reduce your spending, you cannot go on that trip to Europe. So that's one factor that's really important. Think about sort of where you are there. Other big one is non-portfolio sources of income, right? So we need to think holistically about where our income is coming from. So the simple one in here is the age pension, right? So if you are getting the age pension, that is essentially at the end of the day, a giant bond that never runs out, right? You are getting a fixed, at least fixed real, when we're looking at inflation, payment. What does that sound like? That sounds like a bond. So you can think of that depending upon how much of your spending needs that takes care of. You can think about that a little like a bond, which may impact your asset allocation in your actual portfolio. All sorts of different places you can get income from. Obviously, there are some people that do have defined benefit income that they get. So forms of pension schemes. You could choose to invest a portion of your portfolio in an annuity. So once again, we can think of an annuity a little bit like a bond. We know we're going to get these payments, and depending upon the type of annuity, we know we're going to get them for the rest of our lives. You could own investment property where you are, that perhaps is paid off and you're getting that rental income. So you got to think of everything holistically, because that's going to inform the asset allocation you make. You also have to think about non-retirement related goals. So, I think we assume a lot when we sort of talk about this stuff that, we're worried about longevity risk. We're worried about not running out of money before we die. But other people have goals after they die. They don't want to die with $0. That would not be a good outcome for them. They have a bequest to either a charitable organization, perhaps family members that, they want to leave something behind. So it's important to look at that, because that can inform your asset allocation as well. Particularly if you are doing pretty well, you could very much get really, really conservative, realizing you're not going to run out of money. But if you have something that you would like to pass on, then maybe you can't. Peter is asking for my email address. I will type my email address in here. There you go. So if anyone has any questions, you can send me an email, and I will get back to you perhaps tomorrow, because we have our lunch after this, Emily. It'd be very rude if I was answering emails at lunch, right? All right. So let's look at a couple different asset allocation models that we have here, with that caveat that this is a deeply personal decision, but it's good to have different models. So what I've done is I've just taken from our website the 5 different models that we have, everything from conservative to aggressive. And what you'll notice on here is that there is a time horizon for each one of these. And the time horizon, of course, refers to how long until you want to achieve your goal. And we'll get into some in retirement goals as well. So typically what people do is, and they call this the glide path, typically as people age, obviously, they get more conservative in terms of more defensive, lower volatility assets as you approach your goal. And this is true for retirement, just like it's true for every other goal that you have. If your goal is to buy a house and you want to buy the house in 6 months, you really shouldn't have all the money in the share market. I think we all intuitively know that. The problem with retirement is the goal is not really a lump sum of money, because of course you have to keep investing in retirement. And this is where we have to balance the volatility issues of sequencing risk with longevity risk, that we need to stay invested, because we could have a very long retirement. So we have a retirement of an unknown duration. But what I did is I showed our different asset allocations across all those different asset classes you have. I would say for most people, moving into a conservative portfolio right before you retire is not going to get it done for you, especially with where interest rates are. So it's really looking at the balance that we have. Good question from Lisa. So Lisa says, can we just hold shares as a way of keeping up with inflation, hold other allocations as income sources? Yeah, I mean, I guess my question for you would be, to ask you a question, Lisa, would be, where are you getting this income from, given where rates are right now? So yeah, traditionally, that makes a lot of sense, right? That you would sit there and you'd say, okay, one of the big problems that, and especially with what's going on right now, one of the big problems is you need to not only continue to support yourself in retirement, you need, if you want to continue to support yourself, including inflation, that you need things in your portfolio that will respond well to in inflationary environments. And nothing really responds that well, but shares are a lot better than bonds. The issue you have right now, of course, is yields are so low that you're not really getting anything from bonds. So sort of traditionally you'd sit there and say, I've got some shares for some growth, but I've got these bonds that are paying me this steady income. Well, they're not really now. So that's the problem. So yeah, so Lisa's saying, yeah, from a series of bonds, corporate, local, overseas, as well as dividends. Yeah, I mean, I think a lot of people, and we talked about this before, mostly so I could show a picture of Tina Turner, but there is this sort of notion of Tina, right? There is no alternative, which a lot of people are saying there's no alternative to shares right now, right? Because yields are so low on bonds, because interest rates are certainly projected to go up and are going up. Yeah, it's a tricky problem, but maybe we can answer your question on the next slide. So we've talked about, and we talked about in the last webinar, we talked about the bucket method. So let me spend a little bit of time explaining this once again, and we'll talk about sort of asset allocation within buckets. So normally what you do is obviously you'd be on this glide path where you'd be aggressive, you get closer to retirement, you move into growth, you may move into balance. I don't think most people would probably go past that given where we are now, but yeah, that you would slowly adjust your asset allocation over time, and you'd be adjusting it as you get older and go through sort of your retirement date and into your early retirement. And remember, the concern that you have is early retirement generally. So if you've got, if you have those very negative returns early in retirement, yeah, you're in trouble. But if once you get past maybe 10 years into retirement, you're probably in pretty good shape. But the bucket method, which is, well, there's a lot of different components to it. It's really a withdrawal strategy of how do you manage getting money out of your portfolio, creating that stream of cash that you need to live your life. And what the bucket method really sits there and it looks at these twin risks that we're facing. It looks at sequencing risk, and it looks at longevity risk, and it says, okay, how can we address those in a portfolio in an intuitive sense for people to use? So basically what you do is you can have you can have one bucket. That's not a bucket. That's just your whole portfolio. You can have two buckets, or you can have three buckets. And I can talk a little bit about sort of my approach to this. But that one bucket, this first bucket, is a cash bucket. And very simply what you do is you hold multiple years, and we'll talk about how you decide this, of spending needs in cash. So very simply, this is the bucket where you are withdrawing from. Now, you could have 1 year of spending needs in there. If you're more conservative, you could have multiple years of spending needs in there. And the whole purpose of this cash bucket is when we think about sequencing risk and we think about what is the problem with the market falling very early in your retirement, the problem is that you're selling, right? That you are selling low. It's the same thing why it doesn't matter if you're 30, if there's volatility in your retirement accounts, because you're not selling anything. So it doesn't matter. So you're fine having those low returns early on. Retirement, that's not true. So what this cash bucket does is it prevents you from having to sell. Because you have multiple years worth of living expenses sitting in cash, the market falls significantly. You don't have to sell any of your shares. You just pull money out of this cash bucket. Now, the reaction, of course, that we get from this all the time with this cash bucket is, what a horrible idea. I'm not earning anything on this cash. I am losing money from a purchasing power standpoint, but what you're buying is peace of mind. And remember that is something, right? We could say the same thing. We just recorded this podcast where we use this example. It's the same thing as insurance. What are you buying with insurance? Peace of mind. Like, your house probably isn't going to burn down, but it could. And that would be devastating. If you are younger and you have life insurance so that you can leave money to your family if you pass away and you can't earn anything, what are you buying there? You're buying peace of mind, even though you probably won't die. Well, it's the same thing with cash. You are buying peace of mind, and you're buying this peace of mind that the bad luck of having the market fall significantly as you retire is not going to impact you. And what we need to think about, and what this allows the share portion of our portfolio to do, is it allows it to recover. Because we're not selling when it's fallen significantly, it allows those shares to recover. And the real question for all of you, if you are doing this, is how much cash should you hold in there? How many years worth of living expenses should you hold in these accounts? Because what you're really saying is, how long will it take the market to recover? So that's the cash bucket. Then you've got these other buckets, one or two other buckets. So generally what this short-term bucket is that is stuff that you will use for your medium-term spending needs. So now you can take some more risk. Now, kind of generally the approach that's suggested is this is where you would have your fixed interest. This is where you might have safer shares. So when we say safer, we mean lower volatility shares. So if we start thinking of attributes of shares that generally in the aggregate have less volatility, larger companies, dividend paying companies. If we sit here in Australia and we sort of think through what would go in there, maybe the banks, Telstra, things like that, not that exciting, big companies. That's what you would put in that short-term bucket along with your fixed interest. You've got this long-term bucket where you have shares. So what you're doing is, in a normal circumstance, you are constantly replenishing this cash bucket. So normal being the market is not significantly dropped. So you are earning income out of these two buckets. You're taking that income, you're putting it into the cash bucket. You are selectively selling things, which is fine, right? Because you're not selling at the bottom of the market. So market's doing well, you trim some holdings, add it back into the cash bucket. The other thing that I think is an important thing, and I know we've got a couple questions, which I'll get into in a second, the important thing to consider is that obviously, and we get this question a lot, obviously when we're talking about retirement in Australia, we're talking about superannuation. There are certain rules around superannuation, namely that you need to make withdrawals from super that potentially are in excess of what would be considered a safe withdrawal amount from your portfolio. But that's where this cash bucket comes in handy as well. And where should this cash bucket be located? Well, it could be located in your super if you want it, but it also could be located outside of your super, and you can have a portion in both, right? And what this allows you to do is, number one, we want to keep growth assets in our super because there are tax advantages, but we're okay with cash generally outside of super. If you're going to pay that marginal tax rate, pay it on cash where you're not earning basically anything right now. And think about, other things you could put outside of super, or some of the short-term bonds where you're also not earning a lot. So we want to make sure that the biggest taxes we get from high income holdings that we have and from capital gains, if we're selling it, we want to keep that in the tax advantage area, but we can hold cash outside of it. So it allows you to sort of fund that process as well, right? When you are selling to meet those required withdrawals from your super. Oh, now you're handing out my email address, Emily. Oh, that's good. All right, so Carrie's asking, would it be best to be moderate or conservative rather than balanced prior to reaching preservation age? I'm 2 years away from preservation age. Yeah, if we go back, so I don't know which slide you're talking about because we're obviously using the same ways to describe this. And what we're looking at in terms of longevity here, because this is a retirement strategy, we're looking at longevity in terms of how long you expect to live at the end of the day. And obviously none of us know that, but logically, if you're 80 and if you're 60, you're gonna have a longer lifespan at 60, right? Like we get that logically. Or if, Carrie, you were looking you're looking up, going the wrong way, or if you're looking back here between moderate and balanced. Yeah, obviously, what I would say, Carrie, is I can't answer the question. Number one, because that's personal advice, and number two, because I don't know anything about you other than the fact that you're 2 years away from preservation age. What I would say is think about, think about your life. Think about the things we were talking about in that other slide. What is your spending between sort of wants and needs? Could you potentially continue working? Would you want to continue working if the market goes down significantly, right? Because that is one option that we have, is obviously delaying retirement if the market's fallen significantly. I would look at what some of those other factors are. So I obviously can't tell you what to do. But yeah, think about what you're giving up between moderate and conservative. Think about what you're giving up in terms of return potential. And maybe that is fine with you. Maybe you've already hit your goal. Maybe you're very comfortable with where you are from a retirement standpoint, and you do want to go as conservative as possible because volatility is really what's going to ruin it. You could be sitting there saying, I'm in great shape for retirement. I do not want to keep working. And in that case, you'd say, I'd rather be conservative because the biggest risk to me is that I have to keep my job for a year longer. Okay, so we've got a good question from Irene. So Irene is saying that financial advisors used to suggest that your retirement fund should be 15 times your yearly spending, but due to a life expectancy nowadays, should it be adjusted to a higher level? Okay, so what they're doing there, Irene, is they're talking about a withdrawal rate, and they're trying to put it in a way that's simple for people to understand. What you can do is the opposite, is you can also look at your spending and you can divide it by the withdrawal rate that you're going to use. So, very simply, I'm trying to do some math here to figure out this 15 times thing. Listen, I would say when I sit there and look at 15 times, I think that is extremely, I would be a lot more conservative. I would want a lot more than 15 times. So what we're looking at there is, as I said, we're looking at that withdrawal rate. So what you can do is take how much money you are, take how much money you want. I'm sorry, I can't do the math in my head and I'm struggling with it here. Take how much money that you want to have and divide it by that withdrawal rate. So we talked a little bit how much yearly spending you want your portfolio to support and divide it by your withdrawal rate. So we talked about the 4% rule last time. And we talked about some studies showing maybe it should be 3.3% or whatever, but divide what you want by a number like that. So, 4%, if we're considering that safe, that means if you wanted, just to make round numbers, if you wanted $100,000 a year, you want your portfolio to support $100,000 a year, and you go and you divide that by 4%, that's 2.5 million. But if I took that $100,000 and I multiplied it by 15, that's 1.5 million. So there's a big difference. So I think that that's a very aggressive withdrawal rate. And the more and the higher the withdrawal rate that you have, the more likely it is that you are going to run out of money, or that sequencing risk will also make you run out of money, but you'll be more vulnerable to sequencing risk. So yeah, I would say that should be adjusted to a higher level, right? When I sit there and I put $100,000 in that example that I just used, right, that's 25 times the amount of annual spending needs that you need to support. So yeah, I mean, that's my 2 cents on it, but we will have, I'll link a couple things when I send out the email afterwards, or you can email me directly, Irene, and ask. I can send you some information on sort of the withdrawal rate and how to think about that. All right. Last chance for questions. I think we're going to end early, which is exciting because I've been doing this for an hour and 40 minutes now, and I'm tired of listening to me talk. But anyway, thank you guys for joining. So what I will do, probably not until tomorrow, we will get an email out that has a recording of this and the slides that we went through. Now, one thing to note is all of these things are up on YouTube. So if you look for Morningstar Australia YouTube, you can go through and see all these webinars. So the recording goes up there first. But anyway, thank you guys very much. And Irene says, enjoy your lunch. So thank you for that, Irene. Are you going to enjoy lunch, Emily? She will. She picked a Sri Lankan restaurant to go to. So we're going to a Sri Lankan restaurant. Shani's coming as well, who is Sri Lankan. And Shani has some concerns about the Sri Lankan restaurant because everyone in the kitchen is white. But anyway, thank you guys very much for joining. I will be back next week.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.